Section 1. The headline trap versus the ownership mindset. Retail investors often find themselves caught in a cycle: excitement and fear, a whirlwind driven by the daily news. They chase headlines, buying into a stock because a story promises explosive growth or a revolutionary new product. They hear about a company that is going to change the world, and they rush to get a piece of the action before it is too late. Then, when the market turns and fear grips the headlines, they sell in a panic, often locking in losses. This is a common and understandable pattern, but it is the opposite of how smart, long-term investors operate. Smart money does not get swayed by the temporary noise of the market. Instead, it focuses on the underlying business, a much quieter but far more telling narrative. Smart money thinks like an owner, not a trader. It looks past the daily stock price fluctuations and digs into the fundamental facts of the company itself. Section 2. The first filter. Is revenue growing steadily? The first filter to apply before considering any stock is revenue growth. Revenue, often called sales, is the total amount a company brings in from customers before expenses. It is the top line of the income statement and the most basic indicator of demand. If revenue is not growing, the business is stagnating or shrinking. Smart investors look for a consistent and predictable pattern of revenue growth over time. They want to see that the company is successfully selling more to existing customers, finding new customers, expanding into new markets year after year. This shows the business has momentum and remains relevant. Fast growth can be exciting, but steady, moderate growth is often a more reliable sign of a durable business. Explosive growth can be hard to sustain and may be a temporary fad. Look at the company's financial reports for the last 3 to 5 years. Is the revenue line on an upward slope? A steady climb is an excellent sign. If revenue jumps around wildly or is consistently declining, be very cautious. Small dips are acceptable if the long-term trend is positive, but large erratic swings are a warning sign of instability or cyclical risk. Understand the source of the revenue growth. Is it from core operations? Repeated sales of primary products or services? That's high-quality growth. Or is it from a one-time event, like selling a large asset or an accounting adjustment? Those can artificially inflate a single year. Ask, is this growth repeatable? Will customers keep buying next year and the year after? Sustainable growth comes from a loyal customer base, not financial engineering. You don't need to be an expert to check. Pull up the company's annual income statements on its investor relations site. Look for total revenue or sales. Write down the number for each of the last 5 years and view the pattern. Does it tell a story of consistent marketplace wins? If yes, the company has passed the first filter. If the revenue picture is weak or declining, stop your analysis and move on. There are thousands of public companies. Don't waste time on one failing this test. The journey begins with understanding what truly matters in a business. Forget the hot tips and the market chatter. Your goal is to become a part owner in a handful of excellent companies that you understand. We will examine how to identify these companies by looking for steady revenue growth, real and tangible profits, and a commanding market position. The second filter are the profits, real. Profit is the money left over after all expenses, cost of goods, salaries, taxes. Reported profit or net income can be misleading. Companies can use techniques to make profits look better. Smart investors dig one level deeper. Focus on cash flow. Cash flow is the real cash moving into and out of a company's bank accounts. A company that reports profits but burns cash is on borrowed time. Like someone whose paycheck looks good, but their bank balance falls. The key metric, operating cash flow, found on the cash flow statement, shows cash generated from day-to-day activities. It strips out noise from financing activities, taking on debt, and investing activities, buying other companies. You want operating cash flow to grow with revenue. Sales up but operating cash flow flat or declining. That's a major red flag. Could mean trouble collecting payments, or expenses spiraling out of control. Another critical aspect, margins. Profit margin shows profit kept per dollar of sales. Check gross margin. Check operating margin, gross margin. Profit after direct production costs. High, stable gross margin shows pricing power. Operating margin subtracts operating expenses. Marketing. Research falling margins while revenue grows. Eroding competitive position might be forced to cut prices or spend more on advertising. To verify profits, look at the income statement and the cash flow statement. On the income statement, find gross margin and operating margin. You can calculate them yourself. Gross margin formula. Revenue, cost of goods sold. Revenue. Operating margin formula. Operating income, JOTS revenue. Then find net cash from operating activities on the cash flow statement. Compare it to net income over several years. Ideally, operating cash flow should be equal to or greater than net income. If not, the company fails this second filter. True profitability is cash in the bank, not just numbers on a spreadsheet. Section 4. The third filter. Does the company dominate its market? The third and final filter is about market dominance. A company that is a leader in its industry has significant advantages that often translate into durable long-term profits. This dominance is often referred to as a moat, an invisible barrier that protects the business from competitors, much like a moat protects a castle. Scale is a primary source of this power. Large companies can often produce goods or services at a lower cost per unit than their smaller rivals, a concept known as economies of scale. This allows them to offer more competitive prices to attract customers. This also allows them to enjoy higher profit margins. Their size gives them greater bargaining power with suppliers, securing better terms and reducing costs. Market leaders often have the power to set prices within their industry. When a company's brand is so strong, customers will pay a premium. It has immense pricing power. Dominant companies can invest more in research and development, creating a virtuous cycle of innovation. They develop better products. They attract more customers. They generate more profit. They fund more innovation. The lead widens over time. To measure dominance, start by looking at market share. How do its sales compare to its closest competitors? Example, one company 40% versus next rival 10%. Clear dominance. Look for network effects. A network effect makes a product more valuable as more people use it. Example, social media platforms. Example, online marketplaces. Each new user adds value for all users, raising the barrier to entry. Businesses with strong network effects are hard to displace. Customers are locked in. Read the company's annual report for management's view. Use search engines to find competitor comparisons. Ask, is this the go-to choice in its field? Ask, is the brand name synonymous with the product? If a company has a clear, durable moat, it passes the third filter. This is a business you can own with confidence for years to come. After applying these three filters, you will often find that the companies that pass are large, well-established leaders. There is another powerful, structural force at play in today's market: the rise of index fund investing. An index fund is a type of mutual fund, exchange-traded fund, that holds a portfolio of stocks designed to track a specific market index, like the S&P 500. Instead of trying to pick individual winners, these funds simply buy all the stocks in the index. This passive investing strategy has become incredibly popular over the past 2 decades, with trillions of dollars flowing into these funds from retirement accounts. Individual investors. This massive flow of money creates a built-in tailwind for the largest companies in the index. Most major stock indexes, including the S&P 500, are market cap weighted. This means that the larger the company's total stock market value, its market capitalization, the greater its percentage weighting in the index. For example, a company worth $2 trillion will make up a much larger portion of the index than a company worth $200 billion. Consequently, when a person invests $1,000 into an S&P 500 index fund, a significant portion of that money automatically goes toward buying shares of the biggest companies, while only a tiny fraction goes to the smaller ones. This mechanism creates a self-reinforcing cycle. As more money flows into index funds, there is constant, automatic demand for the shares of the largest companies. This steady buying pressure helps to support and often push their stock prices higher, which in turn increases their market capitalization even more. As their market cap grows, their weighting in the index also increases, meaning they will receive an even larger share of the next wave of index fund investments. Many retail investors are unaware of this dynamic, without recognizing the powerful passive flow of funds working in the background. It is not magic, it is simply the plumbing of the modern financial system at work. Finding a great company is only half the battle. The other half is having the patience and discipline to let your investment work for you. Smart investors do not engage in frantic trading. They are not trying to time the market's every peak and valley. Instead, they adopt the mindset of a long-term business owner. They accumulate shares of excellent companies over time, often adding to their positions when prices are temporarily down due to market fear, rather than when there's a fundamental problem with the business. They hold these shares through the inevitable ups and downs, focusing on the company's progress over years, not days or weeks. This patient approach allows the two most powerful forces in investing to do their work: business growth and compounding. Compounding is the process where your investment gains begin to generate their own gains. It's often called interest on your interest. For stocks, it's growth on your growth. Imagine you own a share worth $100. If the business grows 10% in a year, your share is worth $110. The next year, another 10% is calculated on $110. You gain $11, not $10. Over 1 year, the difference is small. Over a decade or two, it's extraordinary. This exponential growth can turn a modest initial investment into a substantial sum, but it requires one crucial ingredient: time. Business growth is the engine that drives compounding in stocks. When you own a share, you own a small piece of the underlying business. As profits and cash flows grow, the value of your ownership stake grows too. A great management team can create enormous value for shareholders over a decade by making smart decisions and reinvesting profits to fuel expansion. By holding your shares, you give the company time to execute long-term plans and create value for you. Short-term market swings are just noise. Over the long run, a stock's price tends to follow the fundamental performance of its business. A common misconception among new investors is that they need to own dozens of different stocks to be properly diversified and successful. This often leads to a diversification effect, where an investor ends up owning a large collection of mediocre companies. The gains from a few winners are canceled out by the losses from many losers, resulting in average or subpar performance. Smart investors understand that it is far better to own a concentrated portfolio of a few truly great businesses that you know inside and out. You do not need 20 or 30 different stocks to build wealth. A well-chosen portfolio of 5 to 10 high-quality companies can be more than enough. The primary advantage of a focused portfolio is that it forces you to be highly selective. When you know you are only going to own a small number of stocks, you raise your standards significantly. You will not settle for a company that is just pretty good. Instead, you will insist on finding businesses that pass all three of your filters with flying colors. Investing is not a set-it-and-forget-it activity, but it does not need to be a full-time job either. With a focused portfolio, you can realistically take the time to read the quarterly and annual reports, stay informed about the competitive landscape, and their progress on long-term initiatives. This deeper understanding gives you the conviction to hold on during market downturns, allowing you to make a rational decision instead of an emotional one. Building your focused portfolio should be a slow and deliberate process. There is no rush. Start by creating a watch list of companies you know and are interested in. Then, run each one through the 3 filters. Be ruthless in your analysis. If a company fails a test, cross it off the list. Over time, you will identify a handful of candidates that meet your high standards. You can then begin to accumulate shares, perhaps buying a small position to start and adding more over time, especially during periods of market weakness. The goal is not to find a lot of things to buy. The goal is to find a few truly exceptional things to own for a very long time. Quality, not quantity, is the key to long-term success. In conclusion, The path to successful investing is not about chasing complex strategies or reacting to every piece of breaking news. It is about adopting a simple, disciplined, patient playbook. Smart money wins by ignoring the headlines and focusing on the unglamorous but essential facts of a business, its ability to grow sales, generate real cash, and dominate its market. By systematically applying the three filters, revenue growth, real profits, and market dominance, you can dramatically improve your odds of avoiding bad investments and identifying high-quality companies built to last. Remember the structural advantage large, successful companies often enjoy. Combine this with the ownership mindset. To begin, follow a few simple action steps. Buy slowly and hold with patience. Revisit your thesis once or twice a year and use market panic to add to great companies at better prices.